Well, welcome to Friday Live, everybody. Colin Harper, joined as always by Michael Kutch. This is our Friday. We get together. We talk about the markets a little bit. We talk about some, timely topics. We talk a little bit about financial planning, and we also go over, some questions and case studies we get throughout the week. So, again, thanks for joining us. Before we get rolling, please note nothing we talk about should be taken as a specific recommendation or advice. These are just our general thoughts on the markets. No specific recommendations on investments or anything like that from us, but you'll get our take on the markets. So before I start, though, you may notice something different on my face. My wife certainly did, and she hated it. So, before I get it's March Mustache Madness for those of you who don't know. And there's kind of two stories behind where the mustaches in March came from. The first one is kind of out of the Air Force. There was a tradition that, corpsmen in the Air Force started growing mustaches during the month of March and kind of defying the no facial hair rule. Famously, there was a waxed handlebar mustache worn by Robin Olds back in his time in Vietnam. So there's a little bit of military heritage there, and being founded by a veteran my grandfather who served in the Air Force. We always want to say a big thank you and appreciation to our servicemen and women out there. So that's one reason for the mustache. And then the second reason, kind of March Mustache Madness, is to promote men's health and making sure folks get screened for prostate cancer, things like that. So although I'm not sure if my marriage will survive the month, the mustache hopefully will. So we'll do our best with that. But joking aside, and then so after today, what we're going to do, we'll talk a little bit about, do I have my tax forms? What are some things to look out for? I know we're kind of in that season where everybody's trying to scrounge around, find all those documents that they don't know where, log into old online accounts, find tax documents. So I'll give you some tips and tricks on how to locate some of that stuff and where to find it. But before I do that, I'm going to kick it over to Mike. And then one little bit of housekeeping too. We're also kind of working on getting a podcast going, and we'll provide some information for that here. If you're one of our clients too, or interested in becoming one of our clients, and you have not received our invitation to our market event and virtual wine tasting, please reach out and let us know. We would love to host you to our market update and that's with one of our partners, City National Rockdale. We're going to talk to some of their chief strategists and learn a little bit more about the market as well. Not that Mike doesn't do a fantastic job, but we like to kind of also check with other industry experts along with Mike to kind of reaffirm what Mike's seeing out there in the landscape. But before I do, Mike, kick us off. What's going on in the market this week? What are we seeing? I know we were talking about moving averages earlier in the week, and we were
Always
kind of
talking
testing.
about moving averages.
Always talking about moving averages, it seems like. So kick us off,
For those
man.
of you who don't know what those are, I apologize, but I pay a lot of attention to moving averages because they give a lot of insight. But overall, the markets were trending lower for most of the week. And on Thursday, yesterday, we did break below that 200-day moving average, which is also around the same area that uptrend from October line was. But in the afternoon, one of the Fed members came out and spoke, Fed member Bosnick, and he indicated 25 basis points is more likely to be his base case than a 50 basis point rate hike in the next meeting. So the market really reacted positively to that, and we finished pretty nicely into the green. We did get one other Fed member speak yesterday, Fed member Waller, and he did flag some concerns about the recent strength we've gotten in economic activity. And if that continues, the likelihood of them to have to go higher on their terminal rate. So meaning how high they have to get that Fed funds rate. So the real question is the current level of the Fed funds rate in a restrictive territory yet? We're at 4.75% on the high end of that range. And I think we are. Historically, that number has to get above what the inflation rate is, which based on estimates, I think that's anticipated to come in at 5.9% in the next reading. So that may look like it's not restrictive, but you have to look where inflation's going. And I think inflation will probably drop below 5% in the next couple of months. So I think we are in restrictive territory, but whether the Fed kind of stops at the 5 to 5.25, or 5.25 to 5.5, or if they really think they need to keep going higher and get closer to that 6%. You're hearing a little more talk of the 6% terminal rate, which I would have some concerns with the economy. I think that would do too much damage, but we'll just have to see. We didn't really get anything too exciting in the economic data this week. We got the ISM manufacturing numbers, which pretty much came in line. However, prices paid did tick up on the month. We also got the fourth quarter unit labor costs. That's how much each worker, how much a corporation has to pay per each worker, pretty much. So that came in well above expectations. I think it was almost double what they were anticipating, but that is fourth quarter, so that's pretty lagged. And then the last piece of economic data that we got was the ISM services measure that came out this morning. And just like manufacturing, overall came in pretty much in line. Prices paid did tick down a little bit, but the employment index was up pretty nicely. Whether that will translate into the monthly jobs numbers or not, it's kind of hard to tell. If those positions are filled, they don't necessarily need to be filled in future readings. So we did get a pretty big uptick in treasury yields across the board. I think the 2-year got to the highest level since like 2007. It got, I think, to around 4.9%, and the 10-year crossed above 4%. I think it got to 4.08. So that's not it. The 10-year didn't get to the previous highs that we saw last year, but it should. If that trend continues, it's going to put some pressure on equities. But it's really going to come down to what is the employment report going to be next week. We'll get the JOLTS numbers earlier in the week. That's the job openings, followed by the payroll number on Friday. So I think the estimate for the payroll number is like 208,000 versus last month's 517,000 reading. That may seem like a big decline, but that 517,000 reading is more of an outlier. Now, I think the 207 might be a little too low. We've been kind of trending more toward the 250 to 300,000 range. So you might see a slight uptick, a slight beat on that number, but it's really going to be all about the wage increase. I think that's tracking 4.4%, and that's the same annualized reading that we had last month. So if you did get a surprise on that, that would be the biggest catalyst for stocks to sell off. And then we'll get the true inflation data the week after. I think it's on the following Tuesday. So both will be potentially market moving.
Yeah, absolutely. And so, Mike, those are awesome data points. And I think a lot of our viewers, some of our viewers may be familiar with some of those. But I would say kind of the average person watching our show isn't necessarily is not as invested in that landscape of all the data as you are. And they don't have enough time to be able to really dive in. So when you look at all that data and you see that, and then you go to interpret it, how do you use that data to kind of extrapolate to your investment decisions? So say we just have all this data you got here. Can you talk a little bit about, because I know we get a lot of questions in, how do we come to investment decisions from the data? So maybe talk a little bit about how that data, all those great points you talk about help guide you down the path towards actual investment decisions.
Yeah, so markets are really looking at what the economists are predicting and whether that comes in above or below. Now, that does have an impact on markets, but I'm more interested in what it's telling me about the broad economic picture. So, to summarize that situation, we've seen weakness in housing, and that's likely to continue. I think the 30-year mortgage is around 7% right now. That's quite a bit higher than it was over the past couple of months, but not as high as it was last year. So definitely weakness in housing. That's probably going to continue as the Fed goes higher with their rate hikes. And then you also have manufacturing seeing a decent amount of weakness. Typically, in the past, if you look at the past 100 years, if you see weakness in manufacturing, it tends to cause broad economic slowdown. But that was a time when manufacturing played a lot bigger part of the economy than today. So it does have an impact. It is something to watch. But it's really the next things we're looking to see a decline in our retail sales, which were trending lower, but this month it ticked up. That was the January reading. We haven't had February yet. So really watch whether retail sales continue to fall and whether that eventually bleeds into the unemployment rate. So unemployment is typically the last leg to fall. So I, I kind of don't really buy into the fact, well, the economy is strong because the employment situation is so strong. Yeah, that plays a part, but it is typically the last leg to fall.
Mhm. That makes a lot of sense. So really what it comes down to is you're taking the big picture and kind of narrowing it in from there. So if we're generally optimistic, there are going to be certain sectors that you're more optimistic on than others. And then from there you would dive into those specific sectors or areas and find actual individual investments inside of those if there's specific things we're optimistic on. Is that a fair summary of what you were kind
Yeah,
of talking about there?
yeah, exactly.
Awesome.
There's different sectors that do better in different parts of the business cycle.
I think that makes perfect sense, right? We always hear, I think one of those big buzzwords you always hear every time you turn into CNBC or anything like that is the cyclical stocks, right? Can you tell people a little bit about cyclical stocks, why they're attractive and what those are? I think that would be something that would help the viewers here.
Yeah, so cyclical stocks are sectors of the economy that tend to move with the economy. So when the economic growth is accelerating, they tend to do very well, and when you enter a recession, they tend to do poorer. Um, so a lot of people like those right now, and there is certain aspects to it that is justified. Like we're seeing a lot of onshoring, the supply chains. So corporations are starting to build more plants in the United States, so that would mean more need for materials. Industrials typically do pretty good, but on the other side, we're also seeing a slowing growth environment. So it's a little tricky to whether cyclicals are a good place to be right now, or if they're just going to be good for a couple months. We're pretty balanced with our sector exposure right now, just because the outlook's pretty uncertain right now, at least in regards to the timing of the economic slowdown.
Well, I think that's fair, right? And when we look at it, our philosophy for, and I don't mean to speak for you, Mike, but our philosophy for financial planning and investment management are very similar, right? We focus on what we've seen from a historical perspective long term to kind of give us a base to build from, and then we can make changes here and there, but we do everything with a very long term focus based on all the data, resources, and knowledge we have collected. You and I have been in the industry a decade. If we cheat, we've probably got a couple almost 200 years of experience from mentors we've gathered from, I think, over the course of things. So if we kind of aggregate that experience, right, there's a lot to be told. We often hear history repeats itself. And although there are some unique challenges to the market cycle we're in, I think, we've seen very similar things happen before. And I think, that's would be one of the reasons why you spend so much time in the data, because it really helps. We can compare that to similar cycles when the numbers look the same or we were in the same business cycle. Is that kind of a fair summary of that?
Yeah, I always hate that saying that people do. This time is different. There might be some variation to it, but
It's not that different.
it's usually not.
This time it's different. You always hear that from the big bear market predictors and the naysayers. Like, this time it's different. It's going straight to the bottom. There's nothing we can do. But that's the role we play too in the on the investment management and the planning side. Is it really different than things we've seen before? And our answer is generally no. I think there's always some differences, but if we can extrapolate out a bit, it is hard to. We've seen a lot over the last century in the market, and we have access to all that data, thankfully, and it's a remarkable thing. And it takes quite a bit to actually be able to dive in and surprise us, especially Mike. He keeps a much closer eye on it than I do, obviously, because that's his role for our firm. But I think it's important to note that especially with this cycle, we've been harping on this quite a bit over the past 2 years or so, but it's been a challenging market cycle for investors, both on the institutional side as well as individual sides. The institutional side has the advantage of they don't have emotions in play. When you're talking about big institutions that are managing money, they do not have emotions tied to those decisions, right? They have a very clear set of directives from the board of directors or whatever institution is prompting those. So that makes it a bit easier. Whenever emotions get in play, right, we are apt to make emotional decisions that might not make the most financial sense. I always talk about this when we're planning. We got two Buffetts involved all the time. We got Warren and Jimmy, right? And Warren has those hard, fast rules of financial planning. But Jimmy realizes it's always 5 o'clock somewhere, right? And you need to find the balance between the art and the science of planning. And I think that's same thing with, investment management, right? We need to find a balance between the science and the art of it. Because if somebody had made a algorithm, and I'm sure somebody's claimed they have, that could lock in investment returns every day, what use would spending all this time on the data and research be? So, Mike, that is awesome insights. What are you looking forward to in the coming weeks? Anything specific? Anything that you've got your eye on for the coming weeks on things to focus in on?
Yeah, a couple things. I believe Powell's speaking on Tuesday, and we'll also get the job openings number on Tuesday or Wednesday. And then, like I said, we'll get the payrolls data on Friday and the CPI data the following Tuesday, I believe. So both of those are really what's going to impact the market over the next month. You could see potential 5 to even 10% moves to the upside or downside based on those data points.
Awesome. Well, as I mentioned at the beginning of this, it's March Mustache Madness. Two ties to that, really. We've got the military tie as well as the men's health tie. So for those service members in your life, make sure you give them a big thank you. Just let them know how much you appreciate them. We certainly do here. And a huge thank you to all our servicemen and women. And then, the men in your life too, make sure you have those talks and make sure you're getting screened to men's health issues such as prostate cancers, things like that. Kind of building from there into a bit more of a planning topic. It's tax time, right? I think we've been getting a lot of questions. Hey, do I have everything I need? How do I know? Where can I tell? I would say the best place to start when I go to do my own personal taxes, where I always start, is what documents did I have last year? That's a pretty good place to start. I would start in what documents I had last year, and if no changes were made over the course of the year, that's a pretty safe bet. You can just match up the documents you had last year and go with those. Go to your tax preparer, go ahead and prepare your taxes on your own if you choose to do that. From there, the next thing I always ask is, have I made any changes over the last year? So basically any transfer from one custodian to another. So for example, if you had an account at E-Trade and you got mad at E-Trade for some reason and now it's at Schwab, you would have one from Schwab and one from E-Trade if that was a taxable account or an IRA that you had to take a distribution from. So when we talk about retirement accounts versus non-retirement accounts and what sort of tax documents those kick out, almost all the time, a non-retirement account will kick out a tax document for the year. It's pretty rare that a non-retirement account would not kick out a tax document. So if anything, any dividends were paid, anything was bought and sold, any changes happened in that non-retirement account, it's going to kick out a 1099, DIV, a 1099 B for basis. And most custodians send that in kind of a consolidated packet per account. So if you have any non-retirement accounts, definitely keep an eye out for tax documents for those. Now, retirement accounts are a bit different. You're really only going to receive a 1099-R or that tax document for an IRA account if you took a distribution from that IRA during the year. So if you are taking RMDs, that's a pretty surefire way you're going to get a 1099-R. If you took a distribution, anything like that, that's a pretty good indicator. And then, of course, any of your W-2s, you'll need that. But from the investment side of things, I would say non-retirement and retirement accounts are the two places that most of the tax forms come from. Non-retirement accounts, you're going to get them almost all the time. Retirement accounts, if you're not taking distribution, there is a chance that you might not need any tax forms for that. That's kind of the quick tips on taxes. Mike, anything to add?
Just a question for you. How about a distribution from a Roth IRA?
A distribution from a Roth IRA, I believe, will still generate a 1099-R. So traditional or Roth, you'll still get a 1099-R if that comes out. However, Roths are generally, depending on the circumstances, tax-free. So you may not owe any taxes on it, but it's still a reportable event in 1099-R. That is what I believe to be correct. I know enough about taxes to be dangerous, but I in no way, shape, or form am a tax expert. Just a couple little tidbits of advice there. So that's, Mike, great, fantastic question. You feel free to ask me about my safety once I leave here and my wife sees this mustache again. That might not be guaranteed, just like we can't guarantee anything we say here in this little Friday Live bit. But I hope you all have a fantastic weekend and week. We look forward to catching back up with you next week. Again, a reminder to our clients and, folks who want to get to know us a bit better. You don't have to be a client to attend this event, but we're doing a virtual wine tasting and market update here in a couple weeks. Registration deadline is March 8th, I believe, which is next week. So if you haven't gotten the email and you're interested in that, please reach out. We'd be happy to share that with you and have you join us to learn a bit more about what some of our partners in the industry are thinking as far as the market goes. And would love to invite you back here next Friday, as always, to join us for Friday Live. So stay safe, stay healthy, have a great weekend. Mike, thank you as always.
Yeah. All right. Bye.
All right. And we will see you all later.